Welcome to Market Overtime. I'm Oliver Renick for the Schwab Network. We're here at the floor of the SIBO in Chicago, where the ARKB Bitcoin spot ETF listed and began trading just over 2 months ago after SEC approval. The fund, of course, comes from ARK Invest, where Cathie Wood is the Chief Investment Officer and Chief Executive Officer. She's here with me now to talk about the fund a little bit more. Cathie, great to have you here.
Great to be here, Oliver. Really fun, actually, to be here.
And you've got the ARKB banner right behind you.
I love it. I love it.
Basically a smashing success. You guys are one of the most popular funds. The whole group of spot ETFs has taken in 10 billion, 20 billion if you exclude GBTC flows. You guys are one of the most popular. I mean, congratulations.
Thank you. I mean, we're thrilled with it. We're thrilled with the CBOE, and I think everyone's surprised. But I think there was huge pent-up demand that we did not understand. Didn't want to deal with the wallet issue, but did want exposure. And of course, the SEC gave them the green light. So I think a number of forces came together at once, and here we are.
This has been record-breaking by many ETF standards, without question. The functionality, everything going smoothly with the demand so far?
Oh, very much so. We have an amazing partner in 21 Shares. So they provide our infrastructure and ops. And, you know, these ETFs are not like traditional ETFs in that you're dealing with underlying assets that fork and have, and there are airdrops. So it's not like the traditional equity or bond ETF. 21 Shares has been in this world for 5 years with 46 funds. They've been through booms and busts. They've been through halvings and forks and airdrops. And what I'm very proud of in terms of that part of this rollout is we have on most days the tightest spreads, and I think that surprised people and is one of the reasons, you know, we're right behind BlackRock and Fidelity.
Yeah, you're competing with the absolute giants here.
Yes.
Do you feel that there is an ability to find some alpha within the spot ETF competition? It sounds like that's what you're alluding to with the spreads.
Yes, oh yes, and it's not that it's not just alpha. It is, I think our clients understand, given the due diligence that they have done, that we are slightly differentiated from an infrastructure point of view, a custody point of view, a wallet and number of addresses point of view. And I think they've been surprised to know that this is really important. So I think that's one of the reasons we are garnering assets as well.
You've got about 2.7 billion of assets right now.
Yes.
You've been a buyer of your own fund as well, as you had Bitcoin exposure through other funds, GBTC, BitO, maybe others if I'm wrong, and
yes,
you've sold out of those. Do you know how much of the fund you own right now? How much ARKB you own in other?
We were, well, now with the price appreciation, maybe with the price appreciation, that would be $200 million worth.
Okay.
So less than 10%.
Gotcha.
Yep.
Okay.
Yep.
So it's not
Good
a ton.
question. Yeah.
It's not insignificant either, though.
No, it helped us in the early days because we were able to develop liquidity very early on as we made that transition from, you know, what is now a very high fee product in the context of where the fees are to a lower fee product for our clients.
Okay, and that ownership of ARKB is in ARKW, which is the Internet Innovation Fund,
Yes.
Future Internet. So you've got ARKB and ARKW. Some of your big picks in ARKK are very crypto-centric, Coinbase,
Yes.
Block's a big holding too.
Yes, yes.
I believe Coin's #1 right now in the ARK fund.
Coinbase is #1. Block, I think, is #4, and of course that has a very important Bitcoin story attached to it as well, which many people, they know it as Square and Cash App. They don't know about how involved the Block is with Bitcoin.
Sure.
As it enters emerging markets.
With that connection between the stocks that are exposed to Bitcoin, the ARKB fund already, the ARKB in the ARKW, last time you told me about your your own personal Bitcoin investments. You said you kind of ballparked it somewhere outside of ARK and real estate, like 25%.
Yes.
It's
higher now because of appreciation.
Exactly.
Right? Yes.
Price action's been amazing.
Yeah.
The sell the news thing was a brief moment. Price has been rallying, but in the midst of that, do you ever give any thought? Are there any concerns that you have about the general exposure across all the different funds, your own wealth to crypto?
No, and the reason for that is that all we're capitalizing on right now is the layer of the internet that developers did not build in the 90s because they didn't know commerce and financial services would take place on it. And so this is just the beginning. Think about how big the internet is, how global it is, and how ubiquitous it is. The financial layer has only started.
How have you measured since the ETFs launched who's buying, and if that new buyer from either institutions or holdouts, who is behind it? Who's in the flows, and how has that informed the market cap growth, the price action of BTC?
Yeah, as you know, we can't tell who our shareholders are. Maybe at the end of the quarter we will see the largest shareholders. But the pent-up demand has been in a lot of places. Retail, it has been there because, as I mentioned, people don't want to deal with wallets and hardware and all of the friction that you have to go through to self-custody. And then on the institutional side, the SEC gave Bitcoin the green light, and so institutions understand this is a new asset class. They have been studying it, and I'll tell you why they've been studying it. In 2018, Cambridge Associate, which is a consultant to endowments and foundations, it came out with a study and basically said, you may not like this, but you better study it because this could be a new asset class, and we truly believe it. It is a new asset class, which means that any institution who is looking for low correlations of returns among their assets needs to look at Bitcoin and other crypto assets if they want to increase their return per unit of risk.
The prospectus for the ARKB has a line in there that I can't find anywhere else in ETFs, which is that, I'll make sure I read it directly, it's under the risks category. It says that investments in Bitcoin could decline rapidly, including to zero. Why is that in there?
Why is in there? I think an abundance of caution. Does the investor side of me believe that's going to happen? No, not at all. I think it's unstoppable now.
How much have the market cap changes that we've seen in Bitcoin, when you compare it to altcoins, inform that view? The Bitcoin ETFs have had tons of flows, about 10 billion. Market cap of Bitcoin's grown 500 billion. Altcoins have grown 500 billion. So what's happening here, and how do we connect the ETF to another 490 billion in market cap that's gone up?
Yeah, I think that as both institutions and individual investors and advisors and asset allocators are doing their homework, the light bulb is going on. And basically they're saying, again, they're beginning to understand that, wait a minute, this is nothing but the internet financial system rolling out. This is a big idea. And it's Bitcoin, of course, but then there are smart contracts, DeFi, decentralized finance. We're starting to use this term internet financial system. It doesn't sound as defiant. Okay. It's just technology, at work, and actually making up for lost time. The early developers were in the 80s and the early 90s. Again, they didn't conceive of commerce or financial services. Now we need to catch up.
Do you think these flows are showing a new buyer who has come on board with this concept now? Because the way I think about this market cap is it's hard for me to figure out the connection between the spot spot ETF flows at 10 billion and then 500 billion. I mean, flows don't correlate to price directly, of course. You can have inflows while a fund goes down. But when I look at the overall move, it seems like there's some macro event happening here on top of the ETFs. Am I wrong?
It's interesting that you say that. I think many people are beginning to understand the scarcity value associated with Bitcoin and other crypto assets. And there's something really interesting happening in the world today that is macro, that people aren't connecting directly, but I think they will. In fact, they're not even talking about this. In Nigeria, in June of last year, the government let the Naira, local currency, float. It's a new administration, let it float. It's an oil-rich country. We can support it. Guess what? It's lost 2/3 of its value. And the government is now detaining 2 people from Binance and is insisting, that they need to learn who has been manipulating the Naira with Bitcoin, which we don't believe that's what's going on. What we believe is there is a flight to safety. And we saw this with the regional bank crisis last year. And we had NYCB recently, again, a reverberation of the regional bank crisis. That is also macro. The deposits system-wide are still going down. The problem has not gone away. Bitcoin is an insurance party against counterparty risk. Banks have counterparty risk. Bitcoin does not. And it is an insurance policy to preserve purchasing power and wealth, right? So I think that's happening in Nigeria. I think there's an insurance policy here against, wait a minute, I don't understand, the banking system is still showing deposit outflows. Maybe I should have a little insurance policy because I don't understand that.
When Bitcoin or crypto in the past had big price destructive events, the money generally just disappeared. Exchanges shut down, Kraken shut, or Mt. Gox would shut down rather, FTX shuts down, the money's gone. Now that there are big institutions that are offering ETFs and selling products with prospectuses and legal language, does it change any of the potential recourse if price doesn't go the way you think? If there's a big crash on a weekend and we wake up and ETFs have to liquidate on a Monday or something, is there any different path for recourse now that there are legal institutions involved?
Well, I think regulatory clarity is important and we need more of it. That's the first thing. I think you talk about FTX and Terra Luna, Celsius, Three Arrows.
Well, more I wonder is if there's a big event, are there actually people that will be on the hook this time? Will somebody go to a BlackRock or an issuer like yourself and say, hey, you said this was supposed to be a safety asset and it didn't act like this?
Well, the Bitcoin in cold storage, in our case at Coinbase, will still be there. They can have their Bitcoin. Price discovery is what ETFs are known for. When in 08-09, there were bonds that were not trading. There was no price discovery. Bond holders who wanted liquidity needed to find price discovery in the ETF market and liquidity. So I think you're arguing the case for Bitcoin in the form of an ETF because it's in cold storage that has not touched the internet in our case. The wallets in cold storage have not touched the internet. They are not hot.
Right.
And so the safety and security of Bitcoin.
It's pretty amazing. After talking with Ophelia last time, I mean, that's the biggest similarity to gold.
Absolutely.
But what I'm wondering is now when people are buying a fund, when I go to the ARKB page, right on the reasons why ARKB, it says that Bitcoin is an established digital store of value. I could debate that all day on whether or not it is. It says, as you just mentioned again, that it offers diversification to a portfolio. I would argue the stats show that it is a high beta risk asset. So what I'm wondering is if these things are at all subjective, does it expose you to any recourse if the market crashes and people are upset?
So let's go back to what it is. Is it a risk-on asset that acts like everything else? During some markets, yes, it is right up there with stocks and bonds in some cases. But the important thing we've learned in the past year, and this is where the low correlation comes into view, is that during the regional bank crisis, it was a risk-off asset. It went up.
I have to disagree with you on that,
No,
Cathie.
I know you disagreed the last time.
But the chart will bring up, I mean, I'll let the chart speak for itself, but the correlation with the regional banks actually goes to 1 in the middle of that crisis before the Fed steps in.
On the first couple of days, and then you'll notice the regional banks keep going down. Look at the chart, and look, actually, the chart since then helps make the point I'm making. It has gone straight up. Where have regional banks gone?
Sure, but that's different. That's a return on an investment. What you're saying is that they acted as a diversifying safety play, and the chart says it goes up to correlation with the regional banks, and then when the NASDAQ rallies after the Fed steps in, Bitcoin kicks in as a risk asset. Bitcoin
led, maybe by a few days, but Bitcoin took off because I remember saying during the regional, I said, wait a minute, Bitcoin's going up, what's going on here? And that's when, and I can tell you when we also saw this, when we first gained exposure to Bitcoin at $250 versus the $73,000, $74,000 now, and we believe the journey's just begun. When we took our first exposure, we were on edge every day trying to figure out, okay, how will this behave? And when Greece threatened to leave the European Union, and we got fear again in the euro of reverberation of the European sovereign debt crisis, Bitcoin went up. Bitcoin up on those days. And back then,
the stocks were rallying too.
Back in 2000 and no, I don't think it was as clear cut back then. No, okay. No, it was not. So you're talking about a store of value, a gold. I just told you Bitcoin has gone from $250 when we first got in to $73,000.
That sounds like a great speculative trade.
No, it also sounds like a great store of value, doesn't it?
Well, I guess it depends. That's where the subjectivity of feels comes in. If people have an established relationship of a store of value as something like a gold, which is like you like to compare it to, and then gold trades with a very clear relationship to real yields, whereas Bitcoin trades more attached to risk, does that not put it on the margin in the risk camp?
It also trades risk off. Can you think of any other asset that is risk on and risk off? That's pretty interesting, right?
I can't think of the sovereign bank crisis in Europe. That's a little bit before my time. Since I've followed Bitcoin, especially in the regional bank case, I can't see any scenario where it is disconnected from stocks going up while stocks are going down. There's an instance within the last decade that's happened.
Take a look at the regional bank index, which is what I think we're talking about in this risk-off conversation.
Right, absolutely.
And they've gone nowhere since then.
Sure, just regional bank trade has been a bad investment.
Bitcoin has gone straight up.
Totally.
Store of value. So gold, the value of gold in the marketplace today is $14 trillion. The value of Bitcoin in the world today is $1.4 trillion. 10% of gold. Digital gold is much more convenient than traditional gold, especially if you want it in cold storage, right? So
let's talk about this big event coming up, the halving.
Yes.
Every time in history it's been a positive thing. What are your expectations? What's your kind of baseline?
So it's interesting that this is a great segue from the gold example. So for the first time, the rate of growth of the Bitcoin supply is going to drop below the long-term rate of growth of gold. So long-term, the growth rate of the gold price, the gold supply, is about 1%. With this halving, Bitcoin's growth, the supply growth, is going to drop from 1.9% to 0.9%, below that of gold. Now here's another difference between gold and Bitcoin. When the price of gold soars, what happens? Miners crank up and the supply increases. That cannot accelerates, the supply growth accelerates. That cannot happen with Bitcoin. If, as the price has gone up, the supply growth is not changing at all. It's 1.9% at an annualized rate now. In April, it will drop to 0.9%. And the history is miner difficulty will increase. There will be some dislocations perhaps in the market, just as people understand how is this all going to play out, especially those new to this ecosystem, and then it usually takes off. It's usually very good for Bitcoin. By definition, the price for any commodity is determined at the margin. If at the margin supply growth is going to be cut in half for a commodity, that's huge.
What needs to happen for price to keep the miners going? Price always goes up by like thousands of percents basically in the three halvings that we've had in the year following.
That's right.
Since they're going to have to work twice as hard to get the same Bitcoin. What needs to happen to price? Is there a floor? Is there a minimum appreciation that needs to happen to keep the miners going?
Yes. Well, to keep it, they need to be making money.
Right.
Right.
Because a lot of them publicly traded now. Yeah,
we do have in our Bitcoin Monthly, which we put out every month, that metric. Is the average miner making money here? And when they're not, miners drop out of the system. They can only be invited back in by a higher price.
Right. The stocks have been doing very poorly. Despite Bitcoin's big run, the miners, all of them are off their highs. Most of them are closer to their lows or in the middle of their range. Is there a possibility that they're pricing in something for the halving that strains them, a bad halving?
No, they are behaving like the very long duration assets that we run. If you notice, the NASDAQ is at all-time highs.
Yes.
And many long duration assets, and we would epitomize that. I would put Bitcoin miners in the same position. They are well below their highs. And I think equities
How do you define long
generally,
duration in this? When you say stock funds, like miners?
Yeah, miners, long durations. This is a very long-term growth story,
okay,
right? With legs, as if we're right on where the price is going to go.
Is that how the NASDAQ is too?
Pardon? The NASDAQ is. I actually think there's more of the NASDAQ that's going to be disrupted, and that will suffer through creative destruction than people understand.
Is that why we're getting the concentration we're getting right now?
That's right. People are, they know they have to be in stocks, they have to diversify, they have too much cash, so let me play it safe with an index. We don't think that's playing it safe, actually. We don't, because there is so much innovation. If you talk about robotics, energy storage, artificial intelligence, blockchain technology, multi-omic sequencing, we have never seen this kind of innovation before. And what is the other side of truly disruptive innovation? Is creative destruction.
Sure.
So I think this seeking safety in indexes is not going to end well.
The counter argument, of course, is that right now your ARKK fund is almost at record low relative performance to the NASDAQ at a time when arguably the biggest innovation in technology in, well, I don't know, what decades is happening with AI? How do you explain that to investors?
Well, I explain it because this is the flip side of what happened in the late 90s. In the late 90s, what happened? We had the internet and everybody said, oh my gosh, this, like, where's this going? This is going to the moon, right? Too much capital chased too few opportunities too soon, and it ended badly, right? It ended badly. What we're going through right now is the opposite of that. We've got everyone hugging benchmarks. They're running for the hills. They're scared of long duration, volatile strategies. They seem risky because innovation is it's controversial. It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy, and everyone thinks all you have to own is the NASDAQ. NASDAQ or the NASDAQ 100. We think there is so much disruption coming from even to Alphabet. I don't think it's in a bubble.
If your stocks are the ones that are going to succeed long duration, but the NASDAQ's beating, I mean, something's got to be off there, the NASDAQ or you.
No. I think what's going on with AI now is the same thing as was going on with the internet in the early 90s, not in the late 90s. And Cisco is a great example of how volatile things can be. So many people, I wrote a letter on this, it's on our site, but the email was connected to the internet for the first time in 1993. That is when many people began to say, wow, what is this internet thing? We could communicate with each other via text for the first time, right? Wow, this is a big idea. Cisco went crazy. It went up 30-fold. 1 year, so that was the ChatGPT moment. Email connected to the internet. 1 year later, what happened to Cisco after it had been up 30-fold over the previous few years? It went down more than 50%. Why? Because corporations, enterprises were starting to take this internet thing seriously, and they're saying, wait a minute, this is going to demand a lot of investment, and strategically we have to get together and not just use these tools willy-nilly. We need to figure out a strategy. I think that's what's happening to AI right now. Enterprises are saying, wait a minute, this is way too important. We need to figure out how to harness AI so that we win in this competition. And as they pull back, because they know they have to integrate their data, map out workflows in excruciating detail, right? That corporations are going to pause. And I think that is going to pause everything. And maybe NVIDIA, I have no idea. We have pulled away from it for that reason. But we don't think this is a bubble. Okay. We think just like Cisco went on to
NASDAQ's
massive.
Not a bubble, but you're also undervalued.
We're undervalued.
It's strange because the first time that we spoke, when you came on the show, we did the NASDAQ show, that was almost 8 years ago now. You were talking AI before anybody. But the underperformance of the fund and the NASDAQ, how do you catch up? Do you need to get back into that, trim the stuff that's not working?
This just tells you where investor psychology is. I just gave you the psychological excesses that developed around the internet, right? We're on the opposite side of that. They're afraid. They're afraid of a portfolio that doesn't look anything like any of the benchmarks. We're benchmark agnostic. They're afraid. We truly believe this, the new NASDAQ, what it used to be in the 90s. It is now dominated by mega caps. That's not how, that's not what the NASDAQ was. That's not why people gravitated to it.
Fair enough,
We're the new
it's true.
We are the new NASDAQ.
The concentration point resonates for sure.
Yep.
And your fund, Coinbase, the top holding, Tesla the second, Roku, and Block. So it certainly does look distinct from the NASDAQ. You're betting big on Bitcoin and crypto in every way. Cathie, thank you so much for your time.
Thank you, Oliver.
Thanks for joining us on Market Overtime. Don't forget to download the Schwab Network app on the Apple App Store and tune in 24/7 at schwabnetwork.com.